in my view, everything is mispriced in terms of, compared to sound money. And let me just elaborate on that. The reason that's occurred is that, in 2008, they took interest rates to 0% and they left them there until 15. So you had basically 7 years of free money.
This is the end game of a decades-long monetary experiment. We just talked about it briefly, but what are the hard signals? Is it in data or is it in policy that kind of tell you we're nearing the edge? I mean, is it 2008 all over again or something much bigger?
Close to that. I mean, I think it'll be bigger. It's really mathematically driven, and the development really kind of, if you go way back, and the book talks about this. It started with the Fed, then it got worse in '71, but it was a slow boil until 2008, and that's really when the true monetary chaos started to break out, and they put interest rates at zero and printed a ton of money. And of course, so that was the first big print, and there was another big print in 2020 in the COVID example, and that they created 40% of the money supply in 2 years. And that's what's causing all the inflation and pain that people are feeling right now, which is very sad. And the reason I say it's coming to a head, Jeremy, is just that if you look at the debt to GDP, you look at the U.S. federal government budget deficit, you look at the debt they have to roll over this year, and they focused all on short-term debt because people aren't buying the 10-year, and they don't want to buy the 10-year because everyone recognizes the inflation risk. If you look at the math behind those things, what you see is that it's just unsustainable. And in spite of the good efforts of DOGE, the government efficiency effort by Elon and Trump to cut expenses, it's going to be extremely hard to do because 80% of the expenses are in areas that are kind of considered untouchable. Basically, Social Security, Medicare, Medicaid, defense, and interest. And so, and if you cut the balance of the 20%, even if you took that to zero, the budget still wouldn't balance. So you've really kind of got a situation where the government just has to keep printing money and at an accelerated rate. I mean, one of the quotes in the book is that the problem with inflation is that it's like getting a drug high or a liquor high, and to get the next one, you got to take more. So it's cumulative, and it appears to be coming to a head. And a couple of signals that it's coming to a head that you and I can both see, and it's very obvious to most people. Gold is just relentlessly pushing to record highs every day, week, and month. Here we are at 3,100. Last March, we were at 2070. So that's a 50% move in a year, which is a really large move for gold. It has very rarely done that. And then, of course, Bitcoin also hit a record high of 106.7. It's backed off to 85. But the point is that these are canaries in a coal mine saying, hey, monetary debasement's a problem. We'd prefer to hold gold versus bonds.
Yeah, well said. Critics, will comment to me and they're going to say, we've heard this before, yet the system keeps going. I mean, what makes this different? Is there a specific event that you're watching for?
It's a fair question. And you're right. And I thought 2008 was the big one, and maybe this isn't the big one, but I will say, we'll get to the event in a minute. I will say that what I lean on to we're getting close to the end game is that these events are getting closer together and the amounts are getting bigger. More and more people are becoming aware of it. And as more and more people abandon the bond market, the problem is going to be real. There's also a chart in the book that I think is very instructive, which is done by Hirschman Capital, that shows that countries, when they get to 130% debt to GDP, and the U.S. is at 125 right now, in almost all cases, in fact, in all cases in the book, it shows you that, soon thereafter, there's a monetary event, which involves either a collapse of the currency, a big deflationary event, or very high rates of inflation. So, we're kind of there in terms of the math, and that's kind of what I'm leaning on. In terms of the event, I mean, what I'm watching the price of gold, I'm watching the price of Bitcoin, I'm watching the stock market, and I'm watching the rate on the U.S. 10-year. And, I think that all of those will give us a clue. I mean, when the stock market turns down, if the 10-year doesn't catch a bid, look out, because, it implies that people aren't willing to take their stock cash and put it into bonds because they recognize that bonds are being debased. And also if gold and Bitcoin keep pressing on to record highs, that's going to become self-reinforcing as more and more people say, hey, what's going on? And then they realize what's going on is the government's trapped.
Let's talk a little bit about the stock market. I mean, it's been fascinating to watch. And of course, you've been doing this a long time, my friend. I mean, you've been through various cycles. You've had the dot-com bubble, of course, housing market. Now you call in the book, quote, the everything bubble. So I got to ask, I mean, what makes this bubble a little bit different? And are we entering the final phase, or is there still time to kick the can here, Larry?
Well, that last question, I don't know, and I've been wrong plenty. So they could have a couple more kicks in the can, but we've got to be close to the final phase. And let me describe why I think it's the everything bubble. And it's just because in my view, everything is mispriced in terms of, compared to sound money. And let me just elaborate on that. The reason that's occurred is that, in 2008, they took interest rates to 0% and they left them there until 15. So you had basically 7 years of free money. And then they started slowly raising them in 15, 16, didn't get that far. And in 19, they pivoted and took them back down to 0 again, and they stayed there till 22. So you've really had, kind of, I don't know, call it 11 years of free money. Free money meant that financial players, Wall Street players, private equity firms, hedge funds, et cetera, could borrow at almost nominal to 0 cost and take that money. And what did they do with it? They bought assets that were going up, bonds and stocks, but particularly stocks, less so bonds because they were aware of the inflation risk, and real estate. And so bonds and real estate have become, in my opinion, mispriced, and they got those prices because of all that free money. If interest rates stay high, the housing market is quite moribund right now, and it's moribund because mortgage rates are high, and people bought houses they couldn't afford at higher rates. If they didn't, particularly in Canada, this, you guys can't get 30-year mortgages the way we can. So, a lot of Canadian mortgages are probably resetting right now to higher numbers than what they were taken out at. Mm-hmm. And of course that dampens the housing market. So it was a monetary distortion, Jeremy, that, free money caused a lot of things to get quote unquote mispriced. And my sense is they will revert to the mean. I mean, there are charts in the book that John Hussman did great work on comparing this market to prior markets. This market is more overvalued than 1929 at the peak. And that market went down 82%. It's more overvalued than the dot-com bubble. And that market went down 50%, and the dot-coms went down 80%. So it's more overvalued than '08. That market went down 47%. So, and to me, what this feels like is a bubble in AI stocks, I think. I mean, AI is important. It's real. It's going to change all of our lives. But very much the way the internet was important and real and got overvalued, and then the bubble burst. And of course, the internet came back and did a lot of great, grew afterwards. If you're in the right names, it was a great place to be. But I think we're kind of looking at the same thing happening in AI. There's just been way too much money chasing it, and it's going to burst, and we're going to get a severe correction, and then AI will emerge as an important thing. But so that's kind of how I see it. That's why I call it the everything bubble. All the free money led to the everything bubble.
We need to talk about gold. I mean, it's clear that there's a historical movement happening in the space. We talked about it just before. Right? I mean, it's crazy. I mean, the precious metal just had one of its best quarterly performances since the 1980s. It's currently trading at a new record high above $31.50 an ounce. And we're seeing central banks consciously choose to step up their gold purchases as they increase the share of the precious metals in their reserves. Talk to me about what's happening in the gold market. I need your thoughts on this. I mean, you're one of the few ones that aren't comparing Bitcoin and gold here.
Yeah, you see it and I see it. I mean, we know there's been a lot of physical move from London to the U.S. I'm not sure what that's all about. Recently, just this morning, there was announced a huge purchase of futures that look like they intend to take delivery on them. I mean, there appears to be a little bit of a scramble for gold. I mean, it appears like we're entering a gold bull market. And, it's quote unquote on. Now, that doesn't mean we won't have drawbacks. Of course we will. But, I think that what gold is very good at doing is sniffing out future monetary debasement. I mean, it did it in 2018. It started moving before COVID. And then COVID came along and it really moved. And so I think what gold knows is that the monetary system is broken and that governments will sooner or later be forced into printing money. And it's just front running that move. I think these big buys, by the way, they could be governmentally driven, but I actually tend to think that if you look at it, Jeremy, there's about $950 billion in quote unquote wealth worldwide if you add real estate in there. So call 450 of that, bonds, stocks, cash, art, all that kind of stuff. The other 450 is real estate. A lot of that wealth, I think, is kind of thinking, they're printing a lot of money. There seems to be inflation that might continue. Monetary debasement's a serious risk. Maybe I should own some gold. And the gold market, by comparison, is tiny. The total market cap is about 20 trillion, but really only about 10 of that's available because the other 10 is either in a central bank or on a lady's neck or in a museum. Mm-hmm. So it's actually less than 10. It's more like 6 or 7 is available for purchase. So 950 trillion in assets, a sound money market for gold of 6 or 7 trillion. Well, even if only 5% of the 900 says, "Gosh, I want to protect myself," that's 45 trillion dollars, and that's chasing a $7 trillion market. So what's that going to do? That's going to push that gold price up, right?